Wow, okay. This is crazy. Right now, there is an absolute war of opinions happening around one of the biggest names in the global data world. We are talking about Snowflake. We're seeing massive, and I mean massive, stock price fluctuations. Shares were recently trading around that $227 mark, yet you've got some analysts out there screaming from the rooftops that the intrinsic value is barely $78. That is just a staggering disconnect. On one hand, you have these glowing headlines praising their new AI capabilities as totally world-changing. But on the other hand, reports are saying the stock is priced for a level of absolute perfection that it just can't possibly deliver. So, welcome to this explainer, where we are going to cut through the hype and turn raw data into clarity. If we look closely at the data from our sources, there are three real, structural causes hidden behind these deeply polarizing news headlines. First, there's a fundamental misunderstanding in the broader market regarding their consumption-based revenue model. Second, there's a deep underappreciation for the adoption rates of their new AI-driven products. And third, there is the undeniable, fatal risk of intensifying cloud data warehouse competition. Today, we're going to look purely at the numbers and the structural economic moats to understand exactly what is happening under the hood with Snowflake.
All right, here's our quick roadmap for today's analysis. First, the Snowflake valuation paradox. Second, a financials and fundamentals dive. Third, we'll cover AI moats and industry risks. And finally, number 4, 3 future survival scenarios. Let's dive right in.
Okay, kicking things off with Section 1, the Snowflake valuation paradox.
So the contrast in the news right now is incredibly jarring to me. You have a company that is essentially considered the gold standard for enterprise data storage, yet the gap between what the open market is paying and what deep value analysts say it is actually worth is literally wider than the Grand Canyon. In fact, let me play devil's advocate right out of the gate here. I'm looking at this quote directly from our sources, and it says, the most popular narrative says the fair value sits at $78.83, far below the recent $227.06 close. OMG, 188% overvalued. What does that have to do with our actual stock accounts? Why should a retail investor even bother looking at a stock if the perceived valuation gap is this massive? Are people just blindly throwing money at an AI bubble here?
Well, we must approach this objectively by looking at exactly how the different sides are calculating these figures. That $78.83 figure, that is a discounted cash flow intrinsic value estimate from specific analysts. It's a highly conservative approach which heavily discounts future growth, especially in a high interest rate macroeconomic environment. The open market, however, currently trading around $227, is pricing in a massive AI supercycle. The data indicates that the market is entirely willing to pay a heavy premium for high-margin, highly scalable cloud platforms that have the potential to completely corner the artificial intelligence data market. However, this discrepancy absolutely highlights the immense foundational risk for investors if Snowflake's growth engine stalls even slightly.
To really ground this conversation in reality, let's examine their current market capitalization, $78.3 billion. The market is valuing them at this massive figure because, structurally, they are no longer just a simple software tool. According to the usage data, they have evolved into the core infrastructural backbone for thousands of global enterprises. To put it simply, they hold the keys to the most critical asset a modern business possesses, their proprietary data.
Okay, so what you just said basically means the market thinks Snowflake is completely indispensable to the modern digital economy. But for those watching who maybe don't work in enterprise IT or data science, how on earth are they commanding a $78 billion price tag just for handling data?
Actually, before we get into the heavy math, that concept is a bit too complicated. Could you give a really simple analogy? Give me a 5th grade explanation of what Snowflake actually does day to day to justify being worth $78 billion. Let me break this down for you. Imagine Snowflake as a massive corporation's central nervous system. Step 1. It acts as a massive digital filing cabinet. The data stored in Snowflake is what the industry refers to as the gold layer. This is the most valuable, highly structured information a company owns. Things like global revenue streams, real-time inventory levels, and deeply personal customer consumption data. Step 2. It acts as an automatic organizer. It applies strict governance, security, and context to that data so it doesn't just turn into a chaotic, unusable mess. Step 3. It serves as an AI action hub. Because all of that clean, perfectly organized data is already securely living inside Snowflake, they allow companies to plug advanced AI applications directly into that data without having to risk moving it to an outside server.
Okay, let me make sure I'm tracking here. So what you basically mean is they are the brain, the security guard, and the memory bank of a modern enterprise all rolled into one platform. Got it.
All right, let's pivot to Section 2, financials and fundamental dive.
So they obviously have a great business model on paper, but if you look at the earnings call data from Q1 of fiscal year 2027, the financial statements reveal exactly why the market is paying such a high premium. We are going to focus purely on revenue growth, customer retention, and operating margins here. First, they delivered 34% year-over-year product revenue growth. This shows massive scale in product demand despite broader economic headwinds. Second, and this is absolutely critical to understanding their valuation, they reported a 126% net revenue retention rate. This specific metric proves that if a group of customers spent $100 last year, that exact same group organically spent $126 this year. It proves negative churn. Third, they now have 779 major enterprise customers spending over $1 million annually just on the platform. Whoa, let me get this straight. The crucial point here is that once these massive global corporations actually migrate their complex data over to Snowflake, they are completely hooked. They rarely leave, and they actually end up spending significantly more money with them year after year. That's incredible.
But here is my sharp, contrarian question for you. If they are making this much money, retaining customers like crazy, and growing this fast, why is the stock price so intensely debated by Wall Street? Is all that future growth already completely priced into the stock at $227? Honestly, what does this past performance actually mean for an average investor looking at their brokerage account today?
And that right there is the exact tension the market is wrestling with right now. Their exceptionally high price-to-sales ratio indicates that investors are indeed paying up front for years of anticipated future growth. To understand if this steep premium is actually justified, we cannot just look backwards at past revenue performance. We must objectively examine the internal mechanics of how their revenue actually flows into the business structurally.
To forecast their future, we have to look directly at their unique revenue model. Following the workflow on this chart, you'll see it is a book, bill, consume model. Step 1. They book a massive contract, which becomes what the financial statements call RPO, or remaining performance obligations. This represents contracted future revenue that has not yet been recognized on the income statement. Step 2. They bill their customers annually in advance for compute capacity. Step 3 and 4. Customers draw down from these prepaid bookings as they physically consume compute and storage resources by running queries, pulling reports, and training AI models.
Wait, so they don't even get to claim all that massive contract revenue on their income statement right away?
Exactly. Snowflake recognizes the substantial majority of its revenue only as customers physically consume the platform's resources. The RPO is therefore the most vital leading indicator of their underlying growth. The financial data proves that consumption patterns strictly dictate future bookings. This means their future growth isn't just some illusion based on tech hype, it is structurally baked into their highly predictable, contractual, consumption-based model.
Let's move to the next key metric to see how this consumption builds into outright profitability. The data demonstrates that Snowflake operates with a massive 75% non-GAAP product gross margin. This demonstrates truly exceptional operating leverage for a cloud company. As they scale and as those deeply hooked customers consume exponentially more data and AI resources, the core product remains highly profitable because the marginal cost to deliver those extra compute cycles is remarkably low. 75% margins? Wow. Okay, in plain English, it costs them very little to actually deliver the service compared to what they are charging these huge corporations for it. That is a serious cash machine.
All right, moving along to Section 3, AI moats and industry risks.
We've clearly established they are making great money with incredible margins. But to truly understand their economic moat against competitors, we must analyze the technological megatrend currently shifting the entire industry. Every single enterprise out there is desperately trying to activate their dormant data for artificial intelligence, which is blowing the market wide open. Because of this, Snowflake is rapidly transitioning from a mere data storage warehouse to what the industry calls an agentic enterprise platform. Based on the earnings transcript, Snowflake is building a unifying agentic control plane. This is becoming real through two specific, highly anticipated products, Snowflake Intelligence and Cortex Code. Intelligence gives regular business users a natural language interface to literally talk to their enterprise data, while Cortex Code gives engineers a way to create advanced AI applications and pipelines directly on Snowflake using SQL or Python.
Hold on, wait a minute, Doctor. Agentic control plane. That is way too abstract and complicated. What does that technical jargon actually have to do with our stock accounts? How does building a control plane generate more actual revenue for the company? Simply put, it aggressively drives consumption. As we established on the RPO slide just a moment ago, Snowflake gets paid when customers consume computing power. When users move from just passively storing data to actively running complex AI models, vector searches, and natural language prompts directly on top of that data,
It requires massive, sustained computational power. The usage data indicates that the adoption of these new AI products is increasing core platform consumption dramatically, which translates directly, dollar for dollar, into higher recognized revenue.
This next visual brilliantly illustrates the powerful network effect that is creating their economic moat. Comparing the state of the platform in April 2020 to the projections for April 2026, you see an absolute explosion in AI data cloud sharing activity. Each blue dot and line connection here represents different organizations securely and seamlessly sharing datasets and applications directly with one another.
Really? Look at that. That graph literally looks like a massive galaxy forming in outer space.
It's an incredibly apt comparison. The data proves Snowflake isn't just standalone software anymore. It is becoming the central circulatory system connecting modern enterprises globally. As more customers build AI pipelines on Snowflake, they naturally share that data with vendors and partners who are on the exact same platform. This interconnected foundation creates immense data gravity and becomes entirely irreplaceable. To leave Snowflake would mean disconnecting from this entire digital ecosystem, which for most major companies is operationally impossible.
Because of this deep AI adoption and that sticky network effect we just saw, the market megatrend is expanding rapidly. According to the industry data, Snowflake's total addressable market, or TAM, was $170 billion in calendar year 24, but by calendar year 29, it is projected to more than double to $355 billion. This rapidly expanding TAM, fueled by the desperate global need to activate AI, provides the financial runway strictly necessary to justify their massive premium valuation, assuming, of course, they can successfully capture it against rivals.
Okay, assuming they capture it, that is the massive caveat right there. We absolutely cannot ignore the fatal weakness in this bull thesis. The cloud data warehouse space is heating up rapidly. You have heavy hitters out there in the tech world gunning for this exact same $355 billion pie. Any failure in AI execution or any delay in getting these Cortex tools to work perfectly could leave Snowflake in the dust, right? Correct. The financial sources highlight this as the primary existential risk to the stock. The current high valuation leaves absolutely zero room for operational disappointment if competition intensifies or if macroeconomic IT spending momentum slows down. If competitors offer cheaper or more efficient AI integrations, Snowflake's incredibly impressive 126% net retention rate could drop. If that retention drops, it would instantly devalue their massive RPO pipeline and compress their trading multiples overnight. So to boil that bleak picture down for everyone, they are priced for absolute perfection right now, and one single strategic stumble could be devastating to shareholders. Which brings us perfectly to our final section, Section 4, 3 Future Survival Scenarios.
Okay, let's look at the 3 future trajectories. I need the final verdict here. Break down exactly what this means for the stock's future trajectory based strictly on the hard data we've covered today. We will look at 3 rational scenarios: the bull case, the base case, and the bear case. Each depends entirely on specific data triggers related to product adoption and competitive pressure. The bull case, or highly optimistic scenario, is triggered if Cortex and Snowflake intelligence adoption drives a massive, sustained spike in compute consumption. If this happens, the premium valuation is mathematically justified by capturing that expanding $355 billion TAM, and the stock surges. The base case assumes the current 34% growth and 75% gross margins remain steady, allowing core earnings to eventually catch up to the current stock price, leading to stabilization. The bear case is triggered if competition wins on pricing or features and AI adoption on Snowflake stalls out. And if that bear case hits, what's the damage? If the data shows that happening, the prevailing narrative that the stock is 180% overvalued goes from being a pessimistic Wall Street theory to a harsh reality. We would see the stock plunge aggressively toward that $78 intrinsic value estimate as the growth premium entirely evaporates.
To summarize, the absolute extremes based on the data. The feasibility of the bull case relies entirely on Snowflake's ability to maintain its absolute dominance over the gold layer of enterprise data while effectively monetizing those new first-party AI capabilities. Conversely, the feasibility of the bear case lies in the genuine risk of software commoditization. If large enterprises realize they can run their complex AI models cheaper on a competitor's infrastructure without sacrificing data security, Snowflake's entire ecosystem moat evaporates. Wow. The stakes literally couldn't be higher for their management team right now.
You know, hearing all this data and weighing these massive polar opposite scenarios, there's a famous stock market quote from the legendary Benjamin Graham that perfectly captures Snowflake's exact situation right now. He said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, the market is voting enthusiastically on Snowflake's AI potential, handing it that massive $227 premium. But in the long run, the actual financials, that hard consumption and revenue data we just looked at, will inevitably be weighed.
So I leave you, the viewer, with this provocative question to answer for yourself today. Is Snowflake's AI moat, that massive, expanding galaxy of shared enterprise data, strong enough to justify its steep premium in your portfolio? Or is that 188% overvalued warning simply too loud to ignore? Thank you so much for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer production. We'll see you next time.